to the AJ Brown Show, where we talk about all things investing, options trading, and the like. Now here's your host, AJ, whose primary mission in life is to help you become a better investor.
All right, ladies and gentlemen, welcome back to another episode of the AJ Brown Show. My name is Cyprian Francis, and with me, as always, the main man of the hour, AJ Brown. Good morning, AJ.
Hey, Sip, how you doing? I'm glad to be back.
Back in the middle of summer, the markets are looking good. Today is July 28th. This is episode 91, and I believe the topic of this week is interest rate hikes, because we got some info there. And today it seems like inflation news. So, AJ, what are you seeing? Where do you want to begin? What do you think has the biggest impact on the market so far heading into this lovely, beautiful Friday?
What a confusing week. In fact, let me go ahead. I'm going to pull up our economic calendar. Let's get right into it. There it is. Okay, Monday was boring, right? And then Tuesday, consumer confidence came in. That was kind of interesting, but it was strong. So that's cool. But we know that the Fed started meeting on Tuesday, and then the Fed came back on Wednesday. In the morning, while they were still meeting, we had new home sales. That was light, but we're expecting new home sales, existing home sales, to be light. One, because mortgages are starting to creep up again, but also because there's just this supply issue here in the States. There's got to be something, and I don't know when it's going to come down, but there's got to be some sort of incentive to keep builders building. It's also getting hard for builders to borrow money. So that's just an interesting side issue that could creep into the broad market. Doesn't seem to have done that yet. But the big news was this FOMC meeting announcement. So they did what was expected. We expected a quarter point rate hike. They delivered on that quarter point rate hike. But the real key was what came after, which was that press conference. And, the Fed's words can be like, changing in their rhetoric. And so what the Fed basically said to us was, hey, they have been mentioning the chance of a recession because of all the crazy moves that they made last year, 5% unheard of increase in interest rates in, just a short amount of time. But they took that off the table. They didn't mention it once. So that kind of got people excited. And he sort of hinted at the fact that there won't be any more rate hikes this year, but then right at the last minute said, we reserve the right to make another rate hike. So, okay, we left Wednesday feeling pretty good that, hey, the Fed's going to come in for a soft landing. Inflation's under control. Then we got these GDP numbers out, durable good orders, GDP numbers out the next day. And the GDP numbers, this is the advanced numbers. Remember, GDP numbers come out every month, and they come out first as advanced. Then the next month they revise them, and they call that preliminary, and then final. So the advanced numbers for quarter two came out. We thought things would slow down, and instead they're hot as can be. We have some great numbers. And so that's a question of, is that good news or is that bad news? Good news, yeah, it's good news on its surface, but does that mean more action by the Fed? So yeah, the market took a step back yesterday. They didn't know. Amateur hour folks were pretty bullish, but then throughout the day, as the real investors got in there, they were like, maybe this isn't the greatest news. So they kind of did a little bit of a pullback. It got very confusing. And then this morning, they released the personal income and outlays. This is the number that Alan Greenspan made famous. It's his favorite indicator, and it's been every Fed chairman's favorite indicator since. This is the personal consumption expenditures price index. And let's just take a look at that. Let's do a deep dive on that one really quick here.
And just off that news, the market is reacting positively up. We're up about 0.5%, almost 1% on all the majors.
Because what this is saying is that indeed, and again, we're looking at monthly numbers because the Fed took such aggressive action in a short amount of time that the annual numbers, looking back a whole year, is a little bit sketchy, right? Because what was happening a year ago compared to what's happening now, there's so much different in the setting and the environment that a lot of economists are just looking at these monthly numbers. And these monthly numbers, they don't look bad. In fact, they look good. They're telling us that inflation is becoming under control. So maybe the thought in investors' minds right now is, hey, we're in a setting that we've never experienced before. So, normal rules aren't working. The normal thing that we would expect when we see X or Y isn't really going to play out the same way as we would think, because there's other things happening. And in addition to that, they're saying, hey, maybe jobs are going to stay good for a while. Pay is going to stay good for a while. We're going to do some good GDP. We're going to have some good growth, some good expansion. And at the same time, we're going to tamp down prices. Now, other economists are talking about maybe the supply chain is probably figuring itself out, and that's why we're seeing lower prices. Another one is pointing at like what's happening globally. There's rumors that Japan is going to, or already has, I haven't checked the news headlines, raise their interest rate a little bit on their side. So, that just shows how intertwined the global economy is, especially Japan and the US. So what it comes down to is there's a lot of confusion out there, Sip. And I think that, along with the summer doldrums, with investors not really knowing what to expect next, and a lot of investors just checking out until September when the fall rolls around and people start really focusing on the holiday season. If we take a look at what's going on over here in the charts, you see kind of a week of micro up and down, but then you also see just a lot of stall, right? A stall. We had reached up to this level of ascending resistance, and you can see we went a little bit higher. We had reached our highest close back here on looks like July 19th. Then we eked a little bit higher after some sideways movements on July 25th. You guys know that I like to look at these what I call retracement moves. And so this is the latest retracement move. It hasn't yet confirmed its top. In fact, it looks like today it will probably go and eke a little bit higher. We're reaching up against that overhead level of resistance that I keep talking about, 4,600. There was a lot of buying right to the 4,600 level. So that means that folks that got in at 4,600 will want to get back out and save their shirt and be able to go home and face their family. And so we expect that to be some pretty heavy level of resistance. And I've been saying week in and week out, and mark my words, Sip, that in order to get above that level, we're going to need to see one more contraction phase. And I feel like it would be a really good idea if the markets pulled back, whether it comes to this magenta line of ascending support that I have drawn here, or this cyan line that's a little bit lower. The difference between those two, I drew the magenta line based on the more recent tested lows, whereas the cyan line is from lows since this uptrend started. We're going to have to pull back to one of those, and either one of those would kind of meet our criteria. My criteria is that we're going to pull back to between 4,460 and 4,500. I've got that little 40-point range that I'm just, based on all my experience of the last 20 plus years of trading, we're going to need to see prices pull back, investors kind of reload their bullish guns by seeing a little bit of a pullback, a little bit of a distribution to that range, and then being able to catapult off and get above 4,600. So I see the month of August, us possibly stagnating and pulling back a little bit, as I think is good for the markets, and then pushing off. We'll see if my theory comes true, Sip.
And the beautiful part about your strategy and the value of options is that from at least the 90 plus episodes that we've done is this top is starting to form, which is usually a great sign to get into some of those opening positions, as we like to talk. And we'll go over a few of those examples, but is that the right mindset? Is when, if we're expecting kind of this slowness and maybe a little bit of a pullback, using options in the short term is a great way to take advantage of that?
Oh, absolutely, right? Because with options, we can profit whether the market's going up, down, or sideways. In addition, with options, we can profit on a sideways moving market based on just time, right? So we can actually make a profitable trade just on time passing by. We could also take advantage of this fear and this perhaps confidence that takes over the market. Those are conflicting or contradicting emotions. So when there's fear, we can use option strategies to profit on that. When there's confidence, when there's the summer doldrums, we've got strategies for that. That's the reason why I got into options in the first place, Sip, is so long as you've got an understanding of what you're seeing, what patterns you're identifying right here, right now, you'll be able to go into your tool chest, and you'll have a vast tool chest, because options, there's about 27 different ways to trade the markets, the different patterns you see. It's like having a multi-tool, like a Leatherman that has all those different tools. You just have to use the right tool for what you see. And that's the fun part, is figuring out, making sure you're seeing what you see and then using the right tool. So me saying that there's this overhead resistance in the broad market is important, because that's going to help us decide which tools to pick out for the next couple of weeks of trading.
And it's in line with our trending topic for today, which we'll get back to, where we're kind of discussing the correlation between the broad market and individual names and individual positions. I'm seeing that you pulled up the VIX here, which was going to be next on my list, basically indicating that the market is not too worried. People are not selling these insurance premiums.
Yeah. So this is unusual, right? Because we've got uncertainty and confusion. That's clear based on the daily price action, but the VIX is extremely low. And so what that tells me is that we are in the middle of the summer doldrums, and the folks that are moving price, right? The way that the market moves is based on active investors, and we can see that in the volume in the market. So what I'm seeing is a few voices speaking loudly. So there are some active investors, but it's a small number of people, and they're moving the actual stocks and ETFs and indexes, and not so much working on some of these bigger strategies that some of the bigger investors. I think the bigger investors are kind of sitting by, waiting to see what happens. And so they're calm, right? I'm seeing calm in the overall broad market, but these little intraday price variations, I think, are caused by more skittish individual investors that are just happen to be active, despite the rest of the folks kind of just sitting and taking a seat and watching what happens as things unfold this summer.
And with the higher interest rates, some of these different investment tools have value in just buying it and holding it, right? Even just cash, even some bonds. So the appeal isn't just into the equities, which is kind of probably slowing some things down, along with just everyone being on vacation and traveling Europe and the world and whatnot.
I think there's been a whole, I almost want to say a generation. If you say that a generation is about 20 years, it's more like 15 years, but there's been this whole amount of time where interest rates were nothing, right? And when interest rates are nothing, folks have to search out investments that are going to pay, right? Investors can't just invest in bonds or in their savings account, because those things aren't going to be performing. And so for the last 15 years, folks have been putting their money into all sorts of unusual investments. And I know that from the options world, people have been using options instead of as a hedging tool or as a premium selling tool, like I like to use them. They've been using them as an asset accumulation tool, which is very speculative. But then there's also been, as you know, all sorts of other things like SPACs and REITs cryptos and all these kind of things where people are starting to question their validity, because now that there's this huge recalibration of, we're going to have interest rates for the next generation, maybe not double digit like they had when I was growing up, but more like single digit, like 2% up to maybe 6 or 7%, probably in that range. That's going to kind of recalibrate things to, in history, a more normal setting where you've got stocks and bonds, and people can put money into savings account and make some money over the, have a what we call a risk-free interest rate. So I think there's a recalibration going on, and folks are trying to get their sea legs. They're trying to figure out this new normal, which was an old normal, and I think a lot of old investors know how to deal with this. But a lot of the newer investors that came on in the last 15 years, they're like whipsawed all back and forth. What should we be focusing on?
Yeah, I'd say that's my generation, right? I don't remember interest rates being, 5%, 3%, right?
I remember them being 14%, right? In the late 70s.
Well, that's why you're the guru. All right, on the chart, we've got the probability for the next rate hike.
Yeah, so I've been watching this, and this has been as schizophrenic as the S&P 500 is on a micro level. But at this point, 82% of investors, this is for the September 20 meeting, 82% of investors think that they're going to let it ride, whereas a small percentage of investors think they're going to do another quarter-point rate hike. And I do have to say that yesterday, this number was lower. This number was higher. There was like some belief yesterday, I think because of the GDP numbers, that the Fed might be more aggressive in September, but that's kind of been pulled back with the PCE numbers of today. What we kind of want to do is we want to get investors to stop looking day by day and look farther out in time. And so in order for that to happen, they have to start building confidence in the Fed that the Fed's just not going to do anything unexpected. So we'll see what happens, but right now you're just seeing this whipsaw effect by the active investors, and then you're seeing a whole buttload of not inactive investors usually, and these guys hold a lot of the money, just kind of playing it cool, right?
All right. Just want to remind everyone, as always, we are broadcasting live. AJ and Trey and the Trading Trainer crew have been successfully teaching people how to trade options for almost 20 years now. I think it's the 20th anniversary now. And with that, if you're following along and you want to get a little bit more insight, a little bit more details into what we're talking about with selling premium and options and spreads and things like that, AJ's got a wonderful free workshop, broadcasting daily. We've gone ahead and thrown the link to that in the chat. If you want to learn more, if you want to follow along, head on over there, sign up. Because we're live, we're taking requests. So if there's a name or if you have a specific options question, feel free to throw it in the chat and we'll try and get to it as soon as we can. We've got our trending topic coming up. We've got AJ's pick of the week coming up, and we've got our speed round. So we're going to take a short break and we'll be right back to cover all that. Stay tuned. We'll be right back with you.
I get it. You're afraid of trading in the markets. Guess what? I've got your answer. I've got 4 strategies I'm going to give you along with the tools to make it super easy. I'm going right home, giving you the webinar. I need you to sign up below and meet me in a few minutes.
All right. Feeling very summery whenever I see that video. Oh, did you see the statistics that July has been the hottest month in history?
I don't doubt it. I know that I've been sweating every time I go outside. It's been the hottest month around the world, right?
And I can only imagine that has to have an impact on people's psychology, the things that they do, certain industries, which probably doubles down on the doldrum part, right?
Yeah. I think the hot is getting to everybody.
So we'll see if that has something to do with the global warming, which I can only assume that it does. And then we'll be seeing the opposite effects in the winter. And so keep an eye on
climate change.
Climate change is a real thing. All right. Moving on to our trending topic of the week. Earlier in the show, we did go over the broad market, the S&P. We do that every week. But the question that we have for the day in the trending topic is, does this broader market have an influence on individual names? And if so, how can we keep an eye on that, and how can we use that to our advantage and help us make better individual trades? Because as an options trader, you can trade the broader market or you can trade the individual names. And so do you want to be aware? Do you need to keep an eye on things? What is your approach to this, this mindset of the broad market, individual names, how they correlate with each other?
Well, and that's a good word, correlation. And I'm going to tell you what I do in order to understand this better from a detailed perspective. But first, I'm going to tell you kind of a higher level thought. And that higher level thought is, over the last few years, we've seen a proliferation of exchange traded funds. And these exchange traded funds are different than mutual funds in that mutual funds have a manager who actually is, trading this fund, changing the holdings of this fund as time goes on, changing the positions that make up this fund. Whereas an ETF is kind of like a predefined balance of these individual stocks or other assets in certain percentages, and it just stays like that. So as all these different stocks move up, so does the ETF, and as they move down, and it's all weighted. Like there might be a certain percentage that's Apple stock, a certain percentage that's IBM, a certain percentage that's Microsoft, and this might represent mature tech stock. That said, of these different ETFs and the excitement, because a lot of investors and investor advisors are pushing people to ETFs because it represents diversification. You can trade the whole technology sector and not put your all your eggs in one basket, like on an Apple stock or on an NVIDIA stock. Although if you did put all your eggs in one basket on an NVIDIA stock, you'd be very happy right now. And so a lot of activity is happening in these exchange traded funds. And because of that, it's kind of creating a self-fulfilling prophecy. So many people are liking the tech stock fund that it's in effect pushing up all the components of the tech stock fund, whether or not those components are doing well individually. So for instance, IBM isn't quite, making its earnings targets and things like that. It doesn't matter, because if people are investing in that tech ETF, IBM is going to get pushed up just like Microsoft and Apple. And so that's called correlation, and it's getting stronger and stronger. It's kind of detaching an individual stock from its actual company targets and what the company or the business that sells that stock to the public, it's detaching that from the actual results of that company. So you're seeing more correlation targeting things towards the broad market, and therefore analyzing the broad market. I usually spend about 5 to 10 minutes every evening just looking at the broad market, understanding what it's doing, because it creates for me kind of a tide. But not every stock is completely linked to it. And I guess before I go on, Sip, I'd like to know, how do you, I know you do some investing, how do you decide, whether to factor in what the broad market, what's your process?
Well, I'll tell you, it's definitely not as detailed as yours. And I would always, I definitely don't look at the ETF correlations. And when you describe it, it makes a lot of sense, where it could naturally bring up or down certain names just because they're in that ETF. So I like that. But for me, it's always the broad market. It's usually like the S&P 500. If it's moving up or it's moving down, that has a sway on whether I'll take a certain position. Definitely not as detailed. And that's as broad as I go, but I feel like it can have an effect, like just whatever's going on in the overall market with interest rates and economic news, right? Like the money kind of all moves. And I like your analogy of tides. Like you want to see where the wave is, and then kind of like a surfer, find the right wave to ride and make sure you're kind of catching the momentum.
Yeah. I mean, again, I love that analogy, and I've been using that analogy with my program participants for years. But, what's the best wave to catch? It's the best wave to catch when the tide is coming in, because now you've got those both forces. Because if you catch a wave when the tide's coming out, you kind of are going to mute your returns. And even worse, what if you catch a down wave and the tide's coming out? Now you're going to be going in the complete opposite direction. So, yeah, paying attention. But here's an idea, and I'm going to show you technically. Listen, what I like to do is I actually like to take my watch list. So I hope all of you have some candidates that you're paying close attention to, right? And you might have them consolidated in a list. Like, for instance, over here, I've got, if I take a look at my personal watch list, I've got a handful of these type of candidates that I really like to look at on a nightly basis. And even on the weekend, I'll spend a little bit more time with them. And so what I do on the weekend is, first of all, I've gone in and I've looked at, and you can do this with most research packages, I've looked at which sectors are each of my candidates in. And I have found either the ETF, or there's a lot of different ways that you can follow that sector. But if you can find an ETF, and you could just Google this, you find an ETF that follows that sector. So then on the weekends, and so I follow those sectors as well, the ETFs that represent those sectors, as well as the individual stocks. And so on the weekend, what I like to do is I actually like to take an S&P 500 chart. And so I've got one right here, and I'll go ahead and I'll, what I'll do is I'll make this a chart in the background. So I'll put this thing, you can see here, I'm using the Thinkorswim package. I'm not the best. I use Thinkorswim on some of these shows because I know it's a very popular package. It's not the actual package I like to use, but my package is, I'm using it because I'm an old dog who's been using it for a bunch of years. So I don't want to show it up because I don't want to draw people to it, because it might not be something, it'll distract people. So anyway, you'll notice I brought in the S&P 500 chart here in the background. Now I can take any one of my candidates and I can overlay it, and very quickly, without even doing any analysis. In fact, what I might do is, since the S&P is being shown as a line, I'll show my stock as a line, and I'll look for that correlation, right? When the S&P goes down, does my line go down? When the S&P goes up, does my line go up? And I'll jot down whether or not that correlation is like positive, or if I find a candidate here, let's see if how this candidate looks compared to the S&P. If it goes completely opposite, right? You might find a candidate that doesn't match the S&P at all. And that's something to take note of, right? So I do this every weekend just with a little list of my watch list, and I'll put a check mark to the ones that do link to the S&P versus the ones that don't link. And if I have a few extra minutes on the weekend, I'll do it with my list of sectors too. And a lot of the candidates in my watch list fall in the same sector. So I'll pull up the ETFs and I'll see, does that sector ETF correlate with the S&P? Just by looking at the chart. It takes all of a couple of seconds to just click through your candidates, click through your ETFs and say, does this correlate or does this not match at all? Right? And you'll find that there are some sectors that are just in lockstep with the broad market. And those ones, you'll have to, if you're going to trade any tickers in that sector or trade that sector as an ETF by itself, you'll go ahead and reference the S&P 500 big time because that's going to be an underlying tide. If indeed you find a sector and the candidates within a sector that have, they don't follow the S&P at all, maybe what you do is you reference, on an evening basis when you're ready to place a trade or something, you reference the sector rather than the broad market, because the sector will probably have more to do with the tide that's pushing it. It's like a little lake or a little a sea off of the big ocean. That's going to be influenced by this sector movement rather than the broad market movement. And so that's how I keep track of how much correlation how much I should pay attention to one sector versus another versus the broad market when it comes to the individual stocks. And I only do this once a week because it doesn't change that drastically. So I'll do it once a week, and every once in a while I'll skip a weekend because, like I said, the correlation doesn't really change over time. It's got to be like months, and you might see one sector start to deviate. That's called sector rotation. I might see one sector deviate and no longer go in lockstep with the S&P, but that's kind of my guideline. And I just keep track of what candidates on my watch list are being influenced that way using kind of a technical approach.
So I think the short answer is that the market does have influence. Some sectors a little bit more than others. Certain times a little bit more than others. You always want to be aware of the tide and make your decisions, taking all these factors into consideration, which is exactly what we're about to do now in our next segment of the show. Starting off with AJ's pick of the week. And so we've been talking about the broad market. We've been talking about the power of options. We've been talking about the psychology and the influence behind the broad market. But now everyone wants to know, AJ, well, how can we make some money off of this? How can we take this information, what's going on in the market, these hypotheses, and help our portfolios and put on a few positions? And so let's go ahead and begin with your pick of the week. And in the notes here, you basically said this is perfect for explaining the concept of premium selling. And so AJ's pick of the week this week is Conagra, ticker symbol CAG. What makes this such a perfect setup, AJ?
All right. So I brought up the chart on Conagra Foods. So this is a very boring stock. You won't really find this stock in the news, but it is a very important stock because Conagra Brands, when you go to the grocery store and you read small on the label, they own a lot of the different brands that are sold at the grocery store. I mean, they are a good portion of the foods that we buy and eat from every supermarket out there. So notice that it just likes to go sideways. The investors love that Conagra gives a huge dividend, about 1% every quarter, which means that for a year, if you just buy some Conagra, you're going to be making 4% plus on your money, which is not a bad thing for owning this stock. And so a lot of folks are just perfectly happy. They're not pushing the board of directors of this company to do anything better. If you look at the Conagra sector, you'll notice that it also kind of just goes sideways because, again, that whole grocery store, it's a necessary thing in our world. And so the businesses are going to keep going. There's no fear in those businesses, making the next best product or anything like that. We just got to eat. Okay. And so what's neat about this is you're coming down here at a low. And so this is a perfect time, as we've all been taught, this is a perfect time to be buying stocks. If we don't want to buy the stock, we could actually buy a back month, deep in the money call option. It'll act exactly like the stock, but it'll be at a cheaper price. So we'll incorporate a little bit of leverage into this. And so we set up this initial position that will profit as Conagra Food goes up in price. If you buy the stock and Conagra Foods goes up in price, great, you'll make some money on it. If you buy that back month deep in the money option, call option, it too will do the same thing as Conagra goes up in price. So will that back month option. When Conagra gets to a point where it's kind of hitting this level of resistance, one of the things we can do, and we don't have to be spot on with this, and it depends on if you're trying to get this trade to last a long time or if you're okay with just setting up your protective position. But one of the things we like to do when we buy stock is set up some sort of protective put option trade. By buying this put option, we're guaranteeing that if the stock goes down below that price, whatever the strike price of that put, that we'll have a position that offsets any losses that we have. It's called a protective option. And we generally buy those options 3 to 6 months out. And that allows us, a peace of mind, right? But here's the scoop. If you buy it when Conagra is down near that level, it's going to be expensive. And you won't be able to sell it back later for any more of a profit. You'll probably, if you can sell it back at all, it'll be for a little bit of a loss. So what I like to do is I like to find symbols that are going to have a little bit of upward movement. And again, it doesn't matter how much, especially if you don't care, whether this position lasts for many cycles or not. Just a little bit of difference, a little bit of upward movement, and that's a much better time to buy your protective option. That way, that protective option will be a lot less in cost. The other thing is if I get it where there's a top being formed, I can also sell some premium, right? I'll sell a call option, a near-term at-the-money call option. Those near-term options, they tend to make a lot of money on time passing by. And I'll error to a little bit above where that top is forming. And that'll help me, if not pay for that protective option completely, it'll offset the cost of that protective option even more. So now I bought that protective option at a discount already because I waited for the underlying symbol to get farther away from its strike price. But I've also now sold some premium and I can apply that money towards the protective option. The beautiful part about that is as the stock now starts to fall back down, as Conagra tends to do, that protective option is going to go back up in value. And more than likely, Conagra is going to stop. And it's not, that protective option is going to protect us should it break through that level of support. But listen, history tells us that that support is going to hold. So if it doesn't hold, great. The protective option kicks in. We make a ton of money on the protective option and we get to keep that initial Conagra or back month position, and all is great. But if it does what it's done in the past and kind of stops at that level and starts to go back up again, now we're going to be able to sell that protective option, that one that we had a discount coupon against, for like 4 times its value, 4 times our break-even price, and really make a killing on that protective option. And that premium we sold will most likely, if we are selling it near term, it'll most likely expire worthless, so we won't have to worry about any sort of obligation. And so we can do these trades that when we've got the premium sold and the protective option purchased with those different strike prices, we create kind of a trade zone, and that stock automatically adjusts. If we go above the trade zone, we get out at a max profit. We get exercised automatically. It automatically adjusts because of the option we sold. If it goes back down, then the protective option kicks in. It automatically adjusts because of the protective option we sold. In either case, we create a rock solid trade that we don't even have to think about. It's going to take care of itself, and all we have to do is check in on it every evening. Once it modifies itself or expires worthless, we just reset it and do again. It's a really neat way to trade where you're profiting on these different influences of the different options, and you can create an income stream off of it that, I mean, it's just really an easy investment portfolio to maintain. That's the whole basis of what we do. And Conagra happens to be a candidate that shows it very, very well. And in addition to that, it's at a bottom. So I'm thinking about starting to add to my portfolio, buy some shares of Conagra so I can be selling this premium and buying these protective options in the future.
Awesome. One theme that anyone watching or listening for the first time that you'll learn with the show is we love boring names, right? Boring names eliminate a lot of the risk, help for a little bit more stability, and allows the time component of these positions to work on your behalf, which is a part of the concept of options and the short-term options. And so Conagra, AJ's pick of the week. Keep an eye on that. Moving on to the next segment. This is our speed round all week as AJ communicates with members as he has his mastermind session. People are throwing out names, and we're grabbing them and we're plugging them in, and we're going to do some live analysis. The first name that we're going to start with, I want to ask a question before we dig into it, and that's, what are your thoughts on the new brand name of Twitter switching to X? What are your thoughts on that, AJ?
My question is there any thought being placed? I heard that I forgot if it was India or Pakistan. If it's India, I mean, India is one of the most populous countries in the world. X.com triggered some of their laws around pornography, and so now it's not allowed to be streamed into their country. So, I wonder if there's any strategy and thought behind some of these decisions. Twitter was a perfectly good name. It was recognized by everything. I'm not sure why X.com. And then I heard that somebody had X as their Twitter handle, and it got taken from them without any sort of reciprocation. I mean, it just seems like a reason why I'm not going to be trading Twitter with my premium selling strategy.
Yeah.
How about that?
A lot of drama. What I'm hearing and what I'm reading is that the goal, I don't know if you're aware, in China they have like an app that, or in Asia, that kind of does everything. It's like social media, it's banking, it's right. So I think the concept with X and Twitter is for it to be more than just a social tool, for it to be like incorporating a lot of these other things, which is why I asked the question. Because
like an aggregator?
Yeah, like more of a end all be all, you can do everything on there. And the reason that I bring that up is because Elon, Tesla, X.com initially was a payment processor that turned into this question, or this ticker for the day. And this is Brian from Bangor, Maine, who's interested in your take on PayPal, ticker symbol PYPL. But the original X.com turned into PayPal,
was
right?
PayPal.
And now Twitter is X. And so it's kind of all coming for full circle. But with all that being said, let's take a look at PayPal. Is there an opportunity to use some options to take advantage of any moves to the up, to the down, or in no direction at all?
Well, okay. First thing we have to pay attention to is that PayPal is about to release their earnings August 2nd, after the market close. And so some folks might be wondering, should we trade the strategy that we talked about in the last couple of weeks, which is a calendar spread on PayPal? And why I would say no is just looking at previous earnings. So what you'll notice here on PayPal, last time they released earnings on May 8th, was that investors sold off the day after, right? They really changed the price. And then you take a look at earnings over here. Well, this earnings was kind of digested like ho-hum, which is cool. But then as we go farther back, I like to always look at about 2 years worth of earnings, right? And I look at each one and I say, okay, what about this earnings back in, this is the one we just looked at. Let's take a look at this one. So this one, it was released and then there was a little bit of craziness afterwards. For the calendar spread strategy to work, we want to make sure that investors consistently, especially at the same time last year. So at the same time last year, if we look at the one from last July, or last August, I should say, this is August of 2022. you'll see that investors really popped up price after hours based on what PayPal released for their earnings and their announcement. So that horizontal strategy works really well if there's just a little bit of price action change, not a lot of it. And so this has got a potential for too much movement in price action. And because I don't have a strong sense of what's going on with PayPal, maybe you do. And if you do, if you have a bias on whether it's going to pop up or down or stay sideways, in that case, you might consider a straddle or strangle. Or if you do have a bias in one direction or another, you could use a calendar spread, but when you set it with a strike price that's higher or lower than, depending on which way you think it's going to go. But I don't have that background because I haven't really been following PayPal as a company. So I haven't been looking at what to expect here, but I wouldn't do a calendar spread, at the money calendar spread, expecting for there to be no price action after earnings. In fact, history tells us that investors like to drive price up or down depending on what they hear on PayPal. Okay, so with that being said, I guess my big suggestion is, if you can play the earnings play because you have some information that I don't, do it. Otherwise, I would sit on the sidelines until August 3rd, which is after earnings is released. And if I'm still in this sideways pattern and I'm forming a top, I would look to actually short PayPal a little bit. That means I'd either sell short the stock or I'd buy a back month deep in the money put option. And then once I've got that in place, I would let PayPal drop a little bit in value. And then I would do my typical premium selling strategy. So the first thing I would do is put that protective option in place. In this case, it would be a protective call with probably the $75 strike price, 3 to 6 months out. And then to offset that cost, I would sell some at the money near term options at whatever, and they would be put options. And when I say near term, I'm talking 3 to 5 weeks out. So probably up to the next monthly expiration. And I'd sell them at the money, kind of erroring to the side of out of the money. And I'd start that premium selling engine on PayPal. But I don't want to do that till earnings is released. And so that's kind of my thoughts on PayPal.
All right. PayPal, the original internet bank, sitting on the sidelines, going to let the earnings play out and see if there's an opportunity there. So thank you, Brian. We'll head on up north to Canada. And this is Douglas from Red Deer, Alberta, Canada, interested in Fluor Corp, ticker symbol FLR. Is this some sort of a chemical company?
No, this is all in one. They'll come in, they'll pretty much do whatever you want if you're in a industrial or civil type of situation. So they come in and help governments set up new towns. They'll help oil refineries set up new oil refineries. They'll just plan and do the logistics and initial setup of whatever big project you have in mind. So yeah, kind of almost like a Halliburton. If that resonates. A lot of people hear the name Halliburton and they think energy, but Halliburton sets up and manages the logistics of all the subcontractors to set up a oil well or oil drilling thing out there. And so very similar. I think they might even be competitors, although I think Fluor is actually even more broad-based. They'll do other projects outside of the energy world. With that said, earnings is coming up. And so again, I'm looking at previous earnings, and at least in the last 2 earnings, investors gave us a big fat ho-hum. And let me look over here. Yeah, kind of a ho-hum. The same one last year. This is in August 5th of last year. Again, kind of a ho-hum. Not seeing. So here's what I think about Fluor just from the get-go. And that is, we've got earnings coming up August 4th. And it is before market open. So you might consider, again, I do a little bit more research on the company, but you might consider playing the volatility play that Sip and I talked about on the last two shows. That's where we would buy an at the money calendar spread. The front month option would be about 10 days out, between 5 and 10 days out. Don't use that Friday's expiration. Use the next Friday's expiration. Give yourself a little bit of fluff. And then the back month option would be 6 months out, right? And you'd pick a at the money strike price for this calendar spread. You buy it literally the day before earnings. So since it's a before market open on August 4th, I'd probably look to buy it on August 2nd or August 3rd. And then on August 4th, I would look to go ahead and sell that calendar spread, because you're going to have a volatility crush on that front month option, raising the price of that calendar spread. And I would try as hard as I can. The ideal situation would be that I could buy this calendar spread. I could pick strike prices that are at the money, and I would buy it when the underlying symbol, I would like set up a trigger, a trade in my trading platform, so that the buy order would go out when price crosses that strike price. So if I could buy that calendar spread when it's exactly at the money, and then ideally when earnings has been released and I'm looking to sell it, I again sell it when the underlying symbol price is at that strike price, that will give me the most money from a volatility play. The next best thing is just making sure that whatever price the underlying symbol was at when you bought this calendar spread, that'll be the price that you sell it at. So try to trigger your trades off of a set price, but even better, the set price that's at the money. And this would be a fantastic trade. As far as selling theta decay or time decay premium on this, let me look back about 6 months. I would wait till earnings has been released, and then I would go ahead and think about either setting up my initial position by shorting the stock or buying the back month, the deep in the money, far out in time put option, letting that appreciate when the underlying symbol drops. When the underlying symbol finds a bottom, that's when I'll sell my protective call up here with a strike price around 32 or somewhere at the top here. And I'll offset the price of that by selling my premium, my put option with a strike price down here. And then that would start the premium selling engine, and I'd have that going for the next couple of months.
All right. That's Floor Corp, ticker symbol FLR. Thank you, Douglas. Moving on to a name and a product that I'm a big fan of, and this is Patricia from Tallahassee, Florida, who's interested in the brokerage name Robinhood, ticker symbol HOOD, which I believe is a fairly cheap stock and very active in the option market.
So again, it looks like we're coming up with earnings after market close on August 2nd. Let's take a look at previous earning announcements and earnings releases. If I take a look at the one that was over here, this is November 2nd. And so far, I'm seeing that investors don't really go crazy. Let's see the one last year at this same time, August 2nd. Okay. I see here where investors did take this for a little bit of a ride. Let me look at August 2nd of 2021. This is January 27th, October 26th. Here's August 18th of 2021. Yeah. Well, I think you need to do a little bit of research. Since then, it looks as though investors are kind of, they're yawning every time earnings are released, which means nothing surprising has been happening. So if you want to try an earnings play with a calendar spread, I would probably do that over using a straddle or strangle. If you've got some sort of information on the background of the company and you have a bias, then when you go ahead and place that calendar spread, pick a strike price that's in the direction of your bias, and over, think bigger than the move you expect. So if you're kind of thinking that, hey, investors are going to push price up to 13, use the $14 strike price on your calendar spread. That'll benefit you. You'd rather kind of have it fall short of the strike price that you select rather than it going over the strike price you select. So that's what I would do with an earnings play. In the meantime,
looks pretty stagnant. I mean, at least on that two year.
Yeah, it really does. But it seems to be in this range, and it's finding a top here. So for the premium play, first of all, we're going to wait till earnings is released and digested. But then it looks like if we continue going down after earnings, let's do the same thing we've said with all the other candidates so far. Let's go ahead and sell some Robinhood, short it. If you don't want to short the stock, or if you don't have a margin account and you're not able to short, the alternative is buying a deep in the money, far out in time call put option. Let me get that straight. Deep in the money, far out in time put option. I'm talking going out about 8 months, so or more. I see that there's a February 2024 option. There's actually a January 2025 option. Maybe let's see what kind of activities on the February option. Not much. Let me see what activity is on the January 2025 option. A lot. So I might consider, one of these options. Let's see, extrinsic value over mark price. Maybe something like this $20 strike price or the $17 strike price. Doesn't quite meet my definition for trading at parity, but because of liquidity, I'd probably choose one of those. You could buy this option, and for the most part, this is going to move as this stock goes down. That put option will go up in price. And then once this stock stops going down, that's when you do your protective option. So you put your protective option to protect your investment. You pick a strike price up here, so it'll protect your investment. And then you offset the price of that protective option by selling near term at the money premium. And that's going to create your income strategy where every time you have an expiration of an option, a premium option, every time you roll out your protective option, that's just money in your bank just for holding that short position against Hood. So I think you've got a couple of different opportunities there. I might look at this myself.
All right. Thank you for your insight, AJ. Patricia, we hope that was helpful. Seeing a common trend here, a few of these names still have earnings coming up, and if you want to do the calendar spread play, head on over to our YouTube. We have a couple videos where we've gone over what those look like. Otherwise, sit tight, wait till the earnings pass, and look for a position to put on from there. With that being said, if you've enjoyed the show, if you've enjoyed learning a little bit about options trading, but you're hesitant and you're not exactly sure what to do and you want a little bit more training, AJ's got a wonderful one-on-one training program where you can work with somebody. You can ask a lot of the in-depth questions. You can go into specifics. We can take a look at your portfolio and really give you the sound advice on how to use options to take advantage of it. So if you want to learn more, head on over to the link that we just put in the chat. It's in there. Sign up. You won't be hassled. I guarantee it. It'll be a short and sweet conversation. Unlike, other things that you may sign up for, really just trying to find the right people where this fits. And I know there's a few seats available. So if you're interested, head on over and check it out. AJ, we're getting close here to crunch time, summer doldrums heading into August. What should we be thinking about? What should we be looking at? Any final words heading into this first week of August?
I think everybody who's paying attention to this show should take their watch list and get an understanding of its correlation to the broad market and to the individual sectors that it's running in. and get a better understanding of how the tides affect it, so that you're not just making decisions on how to trade something based on the stock itself and the silo that you're looking at, that individual stock, but that you're also taking into account the bigger forces that work on it. That's what I would do this upcoming week.
All right, watch lists. Take a look at those watch lists. Look at the correlations. Pinpoint some levels there, and that should help you in making better decisions. If you've enjoyed the show, if you've enjoyed the broadcast, hit that like, hit that follow, hit that subscribe button. We're really trying to do our best to provide you with quality content. And if you have any follow-up questions, feel free to send us a DM, leave something in the comments, and someone will get back to you as always. AJ, thank you for your time today. Everyone watching, thank you for tuning in. We'll catch you guys next week.
Bye, everybody.
Thank you for tuning into the AJ Brown Show. If you're interested in learning more about AJ and his investment, over to tradingtrainer.com and create your free account today. And if you're not already a subscriber to the show, hit that subscribe button and we'll get you fresh content daily.